I think these ideas are especially for long-term investors, so a little bit different from the day-to-day trading, but take an eye or maybe add to the watch list positions we're going to mention here. The JP Morgan market outlook. So how will 2024 play out? Actually, they're expecting the market to drop at the beginning or the first quarter of the year, and then potentially move further out, well, increase and improve the market for the following year.
Mhm.
They're expecting good returns for the upcoming year and years, especially for bonds, which we're going to see. So the main four topics we're going to cover today for this JP Morgan market outlook will be inflation, cash, bonds, and also equities. And here, this table, it's actually the market outlook for JP Morgan for next year. A
Mhm.
pretty simple one. Their bull scenario is actually 5,050, which will mean a 10% increase. Their base scenario is actually almost at what we're right now, 4,500, a decrease of 1.5%, and the bear scenario, 3,850, which would mean a drop of 15.5%.
When people say like, "Oh, S&P is going to hit XYZ next year" or something like that with like a certainty, immediately start doubting them and what they used to make that assessment. Financial data is very noisy. There's a lot of variables. A lot can happen in a year. Markets move very fast. So the fact that they're giving these pretty wide estimates, but also estimates that kind of correspond to different possible outcomes, especially when we're this far out and there's so much uncertainty about what next year is going to hold, kind of like makes me like appreciate this a little bit more, I guess.
What I will pay attention is what they have to say about these main topics, which we're going to get into the inflation right now. So they're actually stating that inflation will be sticky. Right? We're going to have to learn how to live with a higher inflation. And although it has cooled quite significantly from the highs of 9% last year to lows of 3.5% as of now. So as it says here in the graph, inflation will likely settle at a higher level than the past decade right now, and they expect a current inflation for the coming years of 4%, while the average from 2010 to 2019 was actually 1.5%. So quite significant move, and many investors are actually scared about where to put the money. So they actually say that even though there's going to be high inflation, higher than we've been used to, they say that big companies, large public companies, will be able to continue a bullish momentum with the pricing power, and also European companies, even though they have a lot of trouble over there. But they specifically mentioned luxury good ones. So like all these Louis Vuitton, White Hennessy, they say that investors shouldn't worry about it. Companies are right now on a good spot for them to benefit, but only large ones. For Europe ones, they actually specifically said luxury good ones. The sweet spot for the S&P 500 is when inflation is between 2 and 3%, which actually the market tends to go up around 14%. Here, you see it's a sweet spot for the market. So if we get what JP Morgan is expecting, a 4% inflation average for the coming years, the average growth on the market, it's 8.5%.
I think like the other thing to remember too, like because inflation is such an important topic, it's that like we also have to remember like how competitive our country is and our currency is and our economy is relative to other countries. Like our inflation rate is obviously higher than typical, but again, that has to be compared to other countries globally to determine like how competitive we are on a relative basis.
Well, they actually said that the current environment, it's a good one to be exposed for real estate, global real estate, infrastructure, transportation, commodities, and timber. They actually mentioned, and this is what I like more about the reports when they go a little bit more specific about some maybe like commodities. They say as commodities start to go up and labor is more costly, now like current buildings appreciate more, which it's harder for them to replace them, which allows them for buildings to actually appreciate. What actually investors used to hedge their portfolios were bonds. And this next cycle, which they expect to start, they're saying that the thing to go is actually real estate, which is, I did not expect that. They said actually commodities and real estate. So This is for people, so maybe take an eye on companies that are involved on infrastructure, transportation, commodities, real estate, and timber. Coming to the cash, second point here about the report on, they say that right now cash is actually not a bad. Cash tends to pay better when interest rates are higher and to pay less when interest rates are actually low. So what JP Morgan believes is that for 2024, they expect interest rates to fall. That's why they're expecting and they're saying that this is a moment for you to go a little bit more into fixed income investments, a little bit more cash. And I like this graph comparing to the performance from 2021 to September of this year. US cash, we can see it's been a really good performance comparing it to the overall world SMCI World Global Equities and Global Bond Aggregate, which have actually underperformed the USD cash. The third topic are bonds, the real MVP. Well, I quote them, we think bonds are now well positioned to deliver on both fronts. What's more, they could also hold up much better against equities than they have over the past decade. So obviously, like I said, their expectations for a long term, they're saying that bonds will actually average a 5% return over this period, which if you take into consideration, it's actually not that bad. No?
It's actually not, yeah.
For those who want a very low risk for their money and just be above inflation.
Oh, for sure, yeah. It's not bad at all. Interesting.
Yes. And so they say, and one of the questions was, do you think you should own more fixed income rather than equity? So JP Morgan doesn't think so. So they're saying basically that they're still bullish on equities. So for next year, they're not expecting a recession on the report from what I read. So the long-term capital management assumptions, it's actually more bullish on bonds right now than it was on the equity at the end of 2021. And then for the 4th point, they talk about equities. I was actually surprised for their comments on equities. They say that they're poised for a meaningful gain in 2024 still, even though we've seen them big rally this year. What I was surprised today is that they mentioned and they say that actually stocks have already went a recession on 2022 on their growth earnings, because they had 3 consecutive quarters that growth earnings were actually down, and 9 of the 11 major sectors had negative earnings growth in 2022. So they said that already equities had their recession. And what is JP Morgan favoring right now on stocks? Well, obviously AI. They still are very bullish. They say that they have profound implications on corporate productivity and profitability. They actually cited this, which was interesting, that a recent study on AI model said that they can outperform expert radiologists at spotting malignant pancreatic cancers. And also bullish on weight loss drugs, GLP-1, which is Mounjaro and Wegovy from Novo Nordisk and Eli Lilly. They said that 2 million people right now were currently taking one of those 2 drugs, Mounjaro and Wegovy. They said that nearly 100 million people can benefit from these drugs. Quoting JP Morgan, they actually said, we see potential upside in the stocks of drug makers with a growing share of the weight loss market. The only 2 ones involved in this is actually Eli Lilly and Novo Nordisk. They also mentioned some sectors such as consumer staples. I took big stocks on this sector. They were not given by JP Morgan, but they said they're bullish also on consumer staples and medical device companies, which they actually said that they have been punished to the downside. So one of your favorites, Julia, Johnson & Johnson, they are bullish on 3 main sectors: consumer staples, medical device companies, and weight loss companies. And I actually like 3M.
I like 3M. I also do, yeah. Interesting. I'm curious to see how consumer staples perform. Because like I said, I am bullish about like weight loss drugs. I think they're going to become more accessible and more popular. Just because like we have been talking for a long time about how obesity in the United States, just globally actually, is just an increasingly prevalent problem. But that's making me kind of question how some of these consumer staple companies might get affected by that. Because like how much Coca-Cola is going to be consumed when everybody's on weight loss drugs, for example. So, but at the same time, if we were to enter into a recession, then consumer staples tend to perform a little bit more stably. So interesting talking points. I think that gives a really interesting and comprehensive overview, I guess, of what sort of variables to look at, keeping in mind that like taking all these variables into account, given how much they can change in the next year, it makes it incredibly difficult to price markets, but you can kind of like lend your own interpretation in terms of like how to trade around this information. Yeah, it's always interesting to see another, like an analyst's perspective, because there's a million different arguments that you can make for all the different points that they did. So I think I'm just intuitively, and we've talked about this before, this sort of like misconception where we're all kind of like waiting for a big correction to happen in the market. We're kind of expecting that, especially if we kind of move more into recession territory, which seems like, honestly, like we've been raging for so long, the thought that we can rage even more or perform even higher. And I know that like certain sectors, especially like semiconductor sectors, chip, tech, healthcare sectors and stocks and all that kind of stuff, those have been raging significantly more than some other like stocks in the S&P 500, some other sectors in the S&P 500. It's crazy to imagine that they could keep going higher given the just immense upward velocity we've seen. But you know, it's always helpful to see another side of that.